Good morning, everyone. This is Brian Wagner, Chief Architect of Prodigio RTS. Today we're going to talk about a mean reversion strategy. I'd like to welcome everyone into the chat this morning. And we're going to have a nice discussion about this RSI mean reversion based strategy and try to hopefully get you guys thinking outside of the box a little bit. Give you guys some brief exposure to some of the many tools inside of Prodigio Wizard Lab. For guys that have been watching this chat pretty regularly, hopefully I can give you guys some new ideas. We kind of started talking about this last week, but we're going to present it again this week. Exactly. So the screen size is going to be smaller, so the broadcast should have much better throughput. For those of you who don't know, Prodigio is the automated trading platform offered exclusively by TD Ameritrade and Thinkorswim. It features many different tools for strategy, automation, and semi-automation of strategies. It focuses primarily on equities day-based trading, but you can use Prodigio and its many scanning features and many new and upcoming scanning features to augment all kinds of trading patterns and trading strategies. In order to get Prodigio, you need to send an email into support@thinkorswim.com with the subject line Prodigio Activation. When they get you activated, you'll have a new button under the Tools or Trade section of the Thinkorswim trading platform, and you launch that and it will open Prodigio in a separate window, and you'll be able to. Prodigio is fully integrated with your Thinkorswim trading account, so you'll be able to manage all the trades and positions in synchronization on both platforms. And Prodigio in general features an array of tools that assist in scanning for trade ideas and in automatic execution of those trade ideas. So every week we host this chat here every Wednesday in the Prodigio chat at 12 o'clock Eastern, 11 o'clock Central. And we try to go over strategy or features, answer questions, talk about some new and upcoming things in the platform. We are especially excited about this scanning build that we have been working on for some time now. Our intention is no less than to make Prodigio the premier scanning tool available on the market. As we get closer and closer to release, we'll show some demos of the various things that you can do with the scanning system, and you'll be able to see that right here as in this chat. Always send questions into prodigio@thinkorswim.com. Join us on the web, especially on our forums, www.prodigiorts.net, and join us here in the chat during the week. So getting back to the content of this discussion, we started talking about a mean reversion strategy last week. And I'm going to cover all the parts of this strategy so you don't have to, no one's going to make last Whenever we analyze these charts using technical analysis, we're always looking at price data, and we're always looking at usually very colorful charts that give us a picture of the way that the price action is happening on stock or stocks or markets, etc. And we infer information from these pictures. We look at the data from multiple angles and we try to draw conclusions and generalizations. But one of the most important things that we do is we try to establish the relationships that exist between different factors that we're studying. Now, when you isolate on a single stock or a single chart or a single security, what you're doing is you're really looking at the various factors intrinsic to this stock. So what do I mean by that? I'm looking at a chart, a 5-minute bar chart of QQQ, which is the NASDAQ Power Shares. And obviously, this is a very actively traded stock. There's very high volume on this security because it's basically a fund that mimics the movement of the NASDAQ. It's very interesting in its behavior because it's so closely tied to the market, and yet it's so highly frequently traded. The volume that trades on this is very high, which means if you are trading, you will get favorable fills because there's typically someone on the other side of the market willing to meet your bid or your offer price, assuming it's within range. the movement of the price, which is driven by the market, it's driven by trades, it's driven by everything, it's driven by economics, creates a picture. And just like the saying where a picture presents 1,000 words, well, this kind of picture probably presents millions or more words. This picture is the manifestation of everyone sitting in front of a trading platform, or doing a web-based trade, or doing working on the floor on the exchange, or working through a hedge fund, or even investing in, say, a retirement portfolio. All of that activity around the world manifests itself in the price action on these stocks. So obviously, all of these factors have intimate relationships with one another. What I decide to do in my trading this morning will affect your trading in the afternoon in a very minute way, but it is all manifested in the price action. And technical analysis is a tool that uses mathematics in order to establish those relationships so that you can see things that are not immediately obvious. Now, when I look at a price chart, some things are immediately obvious. I see there was a gap this morning, gap down in the markets, gap down on the Qs. That would obviously still manifest itself in either some negative movement or sideways type movement. You can see that the major indices, they're generally down, but it's starting to recover a little bit. That trend might continue, whatever. That is kind of obvious when I look at this price chart. I look at this price chart and I see, well, it closed back here at the 58.11 level, and it opened the next morning at the 57.62 level. So the stock price of the QQQ ETF, it dropped by 50 cents per share. That so much is obvious, but what's more important is the ability to look at a chart and see that which is not so obvious. And in order to see these things, which biases your trading in your favor, because it gives you information that is not so immediately obvious, it allows you to make more well-informed decisions about the grand scheme of everything that's happening. Right? So in other words, it's very easy to say, I want to look for gaps, and I'm going to react according to the gap. And if you're a gap trader, I'm not really a gap trader, but maybe you would have said you want to go long on this gap because you have this immediate recovery, and then you have some support on the bottom side, and that support, it establishes itself, and if you had this kind of filled the gap, it went as far as a high of 58.07. So perhaps that would be a gap play, perhaps not. Some people do a gap continuation, some people do a gap reversal. But a lot of times you're not specifically looking for such a specific event. I mean, if you're trading the gaps, which is a pretty cool strategy, you are, but a lot of times you are, say, rebalancing your portfolio, or you're reacting to news and you don't like the direction some of your investments or some of your swing positions are headed, so you want to move your assets from those stocks into a new investment opportunity. Or vice versa, you really like what's happening and you want to invest more in that trade idea. Those kinds of things present themselves to you with much more clarity if you understand the basics of technical analysis and what they're trying to show you. And so that's the justification for why today I'll be talking about this RSI and the MACD. So these two tools go beyond just the basic price information, and they tell you two very specific things. RSI stands for Relative Strength Index, and this is a technical analysis indicator which is measuring the rate of up movements to down movements. Right? So in other words, it's a very blunt way of saying, are more people buying this stock or are more people selling this stock? Is the price action more towards accumulation, more towards going up, or more towards liquidation so that the price is going down and becoming less valued? It's literally a way of showing you up moves to down moves, but it does it in an intelligent fashion. see this string of green bars, and there's a couple red bars littered throughout. As more and more green bars accumulate into the RSI study, you'll see this white dotted line grow. And it goes higher and higher, right? So when I look at this RSI value, so I'm just going to pause for 1 second here. We lowered the resolution on the broadcast to see if this would help. This RSI value, right? Let me know if you guys can, if this is coming through. Okay, good, great. Okay, so going back to where I was, right, with the RSI values. In the very common sense of what RSI does for you, one way to think about it is by looking at green bar versus red bar. As more and more green bars come in to the chart, and you see during this time there's a lot of green bars, this RSI value, it grows to the point where it becomes above 70. Right? So when RSI grows above 70, that's generally considered to be a situation where it's overbought. It's overbought. And the philosophy, the idea behind RSI, which was developed by Wells Wilder in the 70s, is that the stock cannot continue accumulating forever. Now, it can do this for an extended period of time, but it can't happen forever, because otherwise it's not going to be worth anything, because you're never going to sell it. Right? So if you buy something, and if you never sell that for the rest of your life, it's not worth anything anymore. Right? So it's kind of paradoxical if you think about it that way, but when you invest in a situation, that investment, it's only worth something if you liquidate that investment or you do something with the proceeds of that investment at another time. So the idea behind RSI is Wilder used this to say when RSI grew above 70, that's a condition where it's a little bit overbought. And either A, you probably don't want to buy it at this point, or B, you want to find an opportunity to liquidate it. And we're actually going to use RSI for that B, to find an opportunity to liquidate the stock or to sell it and go short. However, as a blunt instrument, just using the RSI by itself, it doesn't give you the whole picture. The RSI stands for moving average convergence divergence. And this was a study also developed in the 70s by Gerald Appel, in the late 70s actually, it's very simple, just like RSI, but it tells you more of the story. And the fruit of the MACD is it is measuring the momentum of a move in price action. Right? So it's not like momentum in the physics sense. Right? So I'm just going to pause for a second here. With the MACD is designed from moving averages, right? And so last week, and I want to kind of just go over this really quick. The way that you create the MACD is the formula is based on two different speeds of moving averages. And what I did was on this chart, I have a 60-period moving average in yellow, and I have an 8-period moving average in blue. And you know, this chat and the content of this chat is all about identifying relationships. By looking at two different speeds, as a lot of us like to refer to it, two different speeds of moving average, you'll see that those speeds have relationships with each other. Right? So the longer term moving average is much slower and it's much more stable and constant, but the quicker moving average, quicker meaning it looks at less periods, so it has a smaller parameter here, that hugs the data more closely and is more representative of the most recent price action. Well, the relationship between the fast move and the slow move changes with respect to time. And if you ever took, say, a college course in calculus or something like that, you'll know that calculus is all about degrees of separation between things. What I mean by that is you look at things as, say, rates, or you look at things as, say, the inverse of a rate. It's all about kind of ratios, and this is where you get into, derivatives and integrals and all that fun stuff that we've all forgotten about by now. But the idea is that you're looking at a relationship which is at 1 degree underneath the basics. So what do I mean by all this? Quite simply, look at the distance between the blue line and the yellow line. That gets fat, it crosses back against itself, and it gets thin. And that is relevant information. It's relevant information which gives you an idea of the relationship of those two moving averages, and that can be measured. And it's pretty beautiful if you look at, you see how this cyan line or this teal line, you have the gap and the moving average crosses below, and then it recovers, right? And we're always talking about support and resistance, right? It kind of recovers, but obviously there's some resistance here, and the movement has continued back into the downward direction, right? So when this happens, this moving average, it gets close to its longer moving average, right? It tightens up. And what that tells me is that the rate is kind of like dropping off, right? So I had this extreme momentum in the downside, and it got really fat. The distance between the yellow line and the teal line got really fat, but then it started to get not so fat. It started to tighten up. And that's telling me that it's losing that downward momentum, right, by tightening up, right? It's gaining some back. It's losing that downward momentum, but that upswing does not sustain. It gets tight, it kind of doesn't know what to do, and then it picks back up again into the downward direction. And this happens all the time, not just on price action, but in these indicators themselves. So you can always use the same ideas to find relationships between indicators. And MACD simply takes this difference that I'm talking about, and that's your red line. And it goes above and below 0, and you'll notice that this red line, when it gets really tight, it's really just the difference between the yellow line and the teal line. That's negative, right, because the teal line's below it, 0.01. Well, that's tight relative to this MACD value. That's 0.14. Right, so this was 0.01 below, 0.01, and this back here, when it's really fat, that's negative 0.14. So this has 14 times more momentum in the downside than at this point. And you can see that that's a significant difference. And you can tie this into your trading. So if you understand that MACD really is only measuring these gaps and how these gaps play in with one another, it's very easy to draw the conclusion that it's a very effective momentum oscillator. And just to finish up the talk about MACD, what it does is it actually takes this, the white line. The white line is the MACD. Because when I set this chart up, I made all the dotted lines, I made them kind of match these two moving averages. So these two dotted lines line up with this white dotted line. And on the RSI, the white dotted line is the raw RSI, so they're kind of like the raw values. What MACD does is it smooths the white dotted line by a factor that's determined by this third parameter. Right, so look at my MACD values here, 8, 60, and 9. Those values line up with my SMA values at the top, 60 and 8, right, or 8 and 60. Quite simply, you have a fast moving average, a slow moving average, and you have this smoothing factor. The third parameter is 9. All that does is it takes your result, right? The white dotted line is the result of that 8 and 60. It takes that result and it just smooths it with one more moving average. That's all it is. It's very, very simple. And the histogram is, one more time, the difference between these two guys. It's the difference between this white dotted line, called the MACD line, and the red moving average line, which is called the signal line. And that creates this colorful histogram. And the reason why they're doing that is because they're using the concept one more time so that you can see not only is the momentum strong or weak, but is the direction of that momentum strong or weak. So when you look at a MACD, the white line, the MACD line, it tells you the momentum. And if it's really far above zero, it's very strong momentum. You see that happens here in this bullish upswing. This white line crosses above zero, and it stays up there for a long time. And what happens on the gap is this gap is significant, and it really brings the MACD down to the point where it's negative. And then it starts to do that pullback, like I just suggested, and then that pullback kind of fails, and it continues the downtrend. Well, you can also measure the degree to which that value is changing. Right, so this gets a little deeper, but that's what the MACD histogram is. And Gerald made it colorful so that it's really easy to look at. Right, so when I look at this chart, right, I see my MACD line is positive, so I'm bullish, but this trend is weakening. It's very bullish, but it's weakening. Right, and how beautiful is that in this example right here? I have this surge. I have this really strong surge, which lasts about an hour and 10 minutes. And then for the rest of yesterday, the NASDAQ ETF, it was bullish. It continued to go up. But that surge was nowhere near as powerful as what had happened earlier on at around 11:30 here. That shows up in this MACD color. The surge is represented by this burst of green. This burst of green says, hey, I am surging to the upside very strongly. And then over here, your MACD values, they're still very bullish. They're still very positive, but it says, well, I'm not really as powerful as I once was. And that kind of sets it up for the reversal or the gap on the next day. It doesn't have to, but that's really just what happens in this chart. And it manifests itself in the technical analysis. So what I'm going to do is use MACD in order to kind of give me an idea about the fundamental direction of the stock. And I'm going to take that idea and I'm going to combine it with the RSI. And with the RSI, I'm going to look for my opportunities. Right? And then here's the out-of-the-box idea. Just like how the MACD, how I take this white dotted line and I compare it with its moving average. I take the MACD value and I smooth it out. I'm going to do the same thing on the RSI down here. Right, now this is not a typical usage of the RSI, but in my examples it's going to do what I'm looking for it to do with it. Right, so for example, this RSI gives me the ratio, and by smoothing it with a moving average, I'm giving myself a mean. Right, what's a mean? A mean is an average. Right, so a mean is another way of saying it's when you take a bunch of values and you find what the average is of those values. This is an RSI of 8 periods, and I have this smoothing parameter of 30. That means values, I'm going to divide it by 30. It's going to give me a 30-period average. It gives me the red line. So the RSI is set up just like the MACD is set up. And the reason I'm doing that is because just like the MACD, the way that I'm going to compare my MACD momentum against its average is I'm going to use the same idea on the RSI to find out where the RSI value is with respect to its mean. And I'm going to use that to find reversions. Right, so this is a little bit different. It's not just 70 and 30. It's not just 70 and 30. I'm actually comparing the RSI against where it was. And that's going to be important, and let me kind of give you some visual explanations of why. I like this upswing. I like this upswing. But when I'm in this upswing, I don't really want to short. I don't really want to short during this time. And the reason is because there's kind of like too much fighting against me. There's bullish movement. If I'm not on the train then I'm not going to get to my destination, right? So if I'm trying to short into this, it's probably a little bit premature. And I know hindsight is 20/20, but I want you to reason in this manner for just a second here. What would be a little bit more I mean, these movements lasted at least maybe an hour. This upswing was about, what, 45 minutes to 50 minutes. This down move lasted at least another hour. And then this may even continue. But I'm kind of biased just based on the technicals here to say that this is going to continue going down. Now, you can't quote me on this, right, because this is pure speculation, but just based on the technicals, it has a sense that this downtrend will continue, that it's not going to reverse back to the upside. Now, there may be a lot of other pivots and things that I'm not considering, but I would just say at first glance, I'm a little more bearish on this than bullish. So the idea is we're going to ride the momentum, right? We're going to ride the momentum. When it's in a bullish movement and when the momentum is strong, we're going to look for opportunities to buy along with that momentum. And we're going to use the RSI to do it, but there's a fundamental dilemma. The fundamental dilemma is that when the stock is being accumulated, the RSI is going to be positive. It's going to be at least above 50, typically, or it's going to be, pegged or way above 70, etc. It depends on your parameters, but the RSI is also going to kind of ride the momentum. So what we're going to do is we're going to find opportunities in that. And the way that we're going to find those opportunities is we're going to say, when is the RSI fighting against its mean? When has it reverted back to the mean? And if the trend continues, the RSI is going to bump back up above that mean. And that'll happen at the dips. You can see there's a couple dips when this moves up, and I'm only looking at 5-minute data. The same concept works independently of your interval. You can do this on 1-minute data, 15-minute data, dailies, etc. But this movement, it dips, right? And see what happens here in this RSI? The white line, it's above the red moving average, and it reverts back to the mean. It actually dips below the signal line here. That 58 is below the 59. When it does that, I'm going to say that this is an opportunity to buy, because we're still in a momentum of an upswing, and that's obvious by looking at the MACD. It's very positive, 0.28. You remember before the numbers I used were 0.01 on the downside, -14 on the downside. Well, 0.28 on the plus side is very bullish. So this has a very bullish tenacity, even though the momentum is starting to weaken a little bit. It's still very bullish. So I'm going to consider this an opportunity to buy. And we're going to create a system that shows us these opportunities, and we're going to plug it into trade optics so that they come into a queue, and then we can look at each one of those signals on a chart and decide whether or not we want to trade it. So here's the summary of the system that we're going to put together. We're going to start very simple. We're going to take all these ideas and we're going to build on top of them. So we're going to ride the momentum, and to start, I'm only going to look at the MACD. I'm just going to look at the white line MACD using these parameters, and I'm going to say if it's above 0, it's bullish. If it's below 0, it's bearish. Now you can see that if you continue this line of reasoning, I can make this even more sophisticated. For example, over here, the MACD is still bearish, if you will. It's still to the downside, but it's weakening a lot. It's weakening so much that the MACD histogram produces a green signal on the histogram. So it says that this bearish move got so weak that it's actually starting to reverse a little bit. I might want to filter those signals out. But just to keep it simple, to make it easy to follow, we're going to say MACD has to be above 0 or below 0, depending on if we want to go long or short. Above 0 to go long, below 0 to go short. And we're going to buy when the RSI value at 80 and a 30 period moving average, when it reverts back to its mean, we're going to accumulate, we're going to buy. And we're just going to look at the kinds of signals those generate, because what we're interested in here is trade idea generation. Remember, these tools are all about automating strategies. And part of that is or kind of learning some of these fundamental technical analysis studies for the first time. Use it as a scanning system and use it to facilitate your trading, to bring ideas to the table so that you can rapidly react to them. So let's do that. We're going to start with MACD, right, bullish or bearish, and then we're going to look for the RSI reversion to its mean on 8 and 30. Right, so let's see here. I want to make sure that I get these parameters straight. The MACD is 8 and 60, right, with a 9 periods histogram smoothing. RSI, we're going to look at 8 period. This is all in 5-minute data, and we're going to smooth it by 30. Right, so let's go over to Wizard Lab. Now, Wizard Lab is how you create the rule in order to generate a trading signal. And what this is it's a drag and drop canvas so that you go over into your toolbox and you tell the system what you want it to do. The way you think of this is as it's kind of like it's a way to do scripting without the scripting, and it reacts to real-time data. So we have source data. Two things, MACD and RSI. So I'm going to go down into technical analysis. Technical analysis has a study for MACD. Right, and these are sorted alphabetically. But if I go down into MACD, there's a couple different kinds of MACDs. This is the classic MACD, which uses exponential moving averages. The difference between an exponential moving average and a simple moving average is quite simply the exponential one, it weights the average differently. That's it. The simple moving average, it just takes a straight average. What the exponential moving average does is it assigns more weighting to the more recent values. So some people think of it as quicker, but really the two are both useful. Both are useful. EMA quite simply just places more importance on the recent data. So we're going to start with MACD, and just so we kind of align with the chart a little bit. And with the MACD, right, we're going to look at a fast length of 8 and a slow length of 60. Right, now the MACD line, it only needs these two parameters, so it doesn't need that 9 period. Right, that 9 is for the histogram. It's for the histogram and the signal line. We don't need that parameter in this case, so that's why it's not here in the MACD. The way that the rule builder in Wizard Lab works is I connect a series of outputs and inputs, and this instructs the system to calculate MACD values off of the 5-minute OHLC bars. And what it does is these MACD values are an output which you can redirect into another study or a logical operation. So our logical operation is we just want to know when the MACD is greater than 0 or less than 0. And you always want to build these rules in two parts. Right? You always want to build rules that give bullish signals independently of rules that give bearish signals. And the reason is these oscillators, when we talk about them, they don't always have the same legends over here. They don't have the same y-axis. RSI, this goes between 0 and 100%. Right? This RSI goes between 0 and 100%. The MACD does not have a range. It's open-ended. And because all of these are different, it's going to matter about going bullish and going bearish. You can't just say do the opposite because it has no opposite. You know, like the opposite on an RSI is completely different than the opposite on a MACD. And also, I'm trying to use a low resolution here to to keep the bandwidth requirements low for this broadcast. So I'll move this around. You know, I got you guys in mind. So we're going to take the MACD values, right? And I just want to know when this is greater than 0. I'm going to start with the bullish. Well, actually, you know what? It's a bearish-ish day. So let's start with the downside. Let's start with the short side. In order to be short, I want to make sure my MACD value is negative, right? So to do that, I have to use a logical study. And a lot of you guys who have been following this for a long time, this is really old hat. And actually, let me do this. Yeah, I got a little bit more room here. The logical operators allow you to just compare things. So if I want something to be negative, I want to make sure that that's less than 0. So I drag that out, and I'm literally reading this as input A less than input B. I'm saying MACD has to be less than. There's another source data for constants. And I can change this. I can make this 0. Just type that in there. And so this is going to give me signals. It's going to fire when the MACD is less than 0. But that's not the only thing. I also want what I call a trigger. I talk about this a lot when I build these strategies. I talk about having filters and triggers. And it's a fantastic concept to apply to any kind of formulaic or automated trading. This MACD acts as a filter. It's kind of blocking out things that I don't want. Right? So I don't want to be buying heavily into a severe downtrend. Right? Because, you know, I'm not going to be riding the momentum. That's adverse to what I'm trying to do in this strategy. So I'm going to use this MACD as a filter, and I'm going to combine it with a trigger. There's a logical operator called AND, and if I drag this out, it lets me combine more than one signal together. And the AND means I need all of the signals to be firing at the same time. So if you have a filter, which acts as something that fires signals a lot, like every bar, you can combine that with a trigger that's not as frequent. And in my chart, the trigger, this RSI, I'm going to say when it crosses back below its average. That doesn't happen on every bar, right? That's the difference. In the MACD, it's above 0 on every single bar while it's above 0. So that logical operator, that's going to fire signal, 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 yes, 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 until here it crosses back below 0. I said the opposite of how I have it set up. But it's going to stop saying yes, 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 yes. It's going to start saying no, 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 no. But the RSI is going to react very differently. It's going to say no, 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 yes. No, 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 yes. No, 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 yes. So it acts as like a trigger, kind of like a snap, you know. It's an event. It's something that pops. So I'm going to combine this trigger here, and I'm going to use a simple RSI study to do so. I'm going to drag this OHLC. I'm going to say, again, look at 5-minute data. That's one of the nice things about Wizard Lab, by the way. One of the nice things about Wizard Lab is you can combine, you can collate intervals together. It's very difficult, very, very difficult to do this in scripts. I'm a professional software engineer, and I find it extremely difficult. So I'm going to scroll down, and I'm going to grab the RSI value here. And down here, again, these are sorted alphabetically, but I've got my RSI. And there's a couple different flavors, but we're just going to use the standard RSI. And my parameter was 8 periods, because I want it to be kind of tight. You know, you always think about these periods or these lengths in terms of, do I want them to be tight? Do I want them to be loose? Do I want them to be snappy to what's going on, or however I want to use them? The actual periods doesn't matter. It's the concepts that matter, and that's something I stress a lot in these chats. This gives me an 8-period RSI, right? And I'm looking for it to cross back below. I'm sorry. This is the short version, right? See, I have to look at this to make sure I remember. This is the short version. In the short version, I want the RSI to cross back above its mean. Let's look at an example. In the short version, I want to look for the RSI to cross back above its mean, right? And when this happens, in this example, that's going to give me a down signal here. which is not the worst signal in the world, but you can see how you can start to refine this, right? And I want to give you all the tools so you can start refining this. But I want the RSI to cross back above its mean. And when that happens, I want to see the short signal. Again, I'm only going to be putting this into trade optics, so I'm not going to lose anything here. I'm only going to see the signals as they come in. So in order to get the RSI mean, I want to compare the RSI versus its average. So what I can do here is I can take a shortcut. I can actually highlight this. I can right click. I can say copy. I left click just to deselect, just to show you, and I can right click again, paste it. That makes another RSI. So I actually have two RSIs right here on my canvas, and I'm going to smooth one of them so that I can compare them. To smooth it, I just use the SMA study. And I can drag this out, and I'm smoothing one of them. And I had this number of periods be fairly generous, because I really want this to be a measurement of, did I get back to what's a typical RSI value? Now, I mean, this all gets very subjective, but it's useful. It's useful. It's saying, where is my RSI relative to what it typically is? So what I'm going to do here is I'm going to fire my triggering signal when the RSI crosses above its average. Right, so I'll go back. I'm going to scroll up. I can also middle click. That's what's nice about Java. I can middle click on this toolbar. I could jump. It's not all scroll bars are created equal. So it's kind of cool that Java does that. I have a logical operator called cross above. Right, and if I drag this out here, now I'm getting a little tight because I'm at a very low resolution. But this canvas, it extends infinitely in any direction. So I can just kind of scroll to the right here. I want to say, tell me when the RSI value crosses above its 30-period smoothed average. And just to give you an idea, I can zoom out, right? And we don't need to tweak the parameters anymore because they're all set, so I can just kind of organize this. I'm going to say, when these two things happen, fire my signal. And what I do is I go into my trade actions, I go into signal, and this is like the period at the end of my sentence. All this is wrapping up the rule. And when that's completed, the rule will be complete. And when I save it, it's going to tell me, okay, the rule is valid. So I can say save as. Right, I'm going to call this RSI mean reversion long. I'm going to call it long and short. This is going to be a long signal. And in order to deploy this into trade optics, I'm going to go to step 2, my strategy builder. Right, I'm going to go down into RSI. Let's see here. RSI mean reversion long. And I'm not going to get into the details of the robotic trading today. You can create a fully automated trading system using just some simple parameter drop-downs and things available in the strategy builder. I'm just going to use it in trade optics. And in order to do that, I just need a scanning signal. So everything works on a strategy. All I've got to do is make a strategy with a single rule in it. And I'm going to say this is my mean reversion to the short side. I named that wrong, didn't I, guys? Let me fix this really quick. This is to my short side. See, I'm getting crossed up between the longs and the shorts. Bearish momentum, mean reversion to the upside. I want to stay short. Right? So let's save this as RSI reversion short. Right? So that's called short. Let me get rid of that long. RSI mean reversion long. We're going to make that one, but I want to make sure I'm 100% unambiguous here. So let's try that one more time. RSI mean reversion short. We want to sell. We want to see sell signals, short signals. The strategy builder defines what kind of signals that you want to see. That's actually kind of nice because you can make a rule that doesn't care if you're going long or short. You might want to decide to do the opposite. And all you have to do is just toggle this direction. This is the trade side. You toggle that, and I'm at a very tight resolution, but that's the trade side. And if I want to go long, I can just flip it. So let me save this one more time, RSI mean reversion short. And I want to plug this right in so that maybe in a couple of minutes we can get some signals for this. Maybe, maybe not. See, the problem is these things are going to have to occur in real time. I may not have enough time to show you the signals on it, but I can at least show you the idea. So I've got down here mean reversion to the short side, and I'm very, very tight. I'm very, very tight on real estate, so I'm going to have to drag some things around really quick. Right, and you can select the symbol list that you want to deploy it against. This S&P 100 is going to be fine. That's now scanning on the server, right? And then this will start producing signals into my trade optics queue as they come in. Now, to illustrate, I want to show you a couple signals on some very greedy strategies that I have set up just to kind of demonstrate signals as they come into the system. As the mean reversion strategy is scanning for signals, they'll come into the trade optics queue, and this is why I made it so simple. When they come in, let's see, do I have any in here? It would be so amazing if I did, but probably not. Yeah, I don't have any RSI mean reversions. I can kind of sort by the name here. And yeah, I don't really have any for the RSI. But as they come in, I click the button on the chart, and it shows me where the signal happens. And so when that mean reversion happens, it's going to give me, well, in my case, the short signals. Let's look at something short. And that system would tell me, okay, you got a short signal here. And you can chart this, and what you can do is you can take everything that you knew about the technicals, you can take a look at the MACDs and the RSIs on the charts, and you can say, okay, knowing what I know about A, what's been going on in the market, B, what I know about support and resistance, C, because I'm listening to Shadow Trader. You guys are listening to Shadow Trader, right? And those guys are amazing. I'm going to make a well-informed decision, and the idea was brought to the table for me using the trade optics. This concept is what we're augmenting right now with the scanning system, which kind of elevates not only the rule building and the strategy building, but we kind of have these kind of out-of-box type of scans. And we're making a lot of great progress on that system, but that's you guys are going to love this when we have this finished, wrapped up. It's just going to augment this like tenfold. So I can't wait to kind of show you guys a demo of that. But the idea here is when they come into the trade optics, you'll get those signals. And unfortunately, I've only got kind of 2 more shots at getting a signal before the chat ends. So there's pretty fair chance I might not get a signal yet. But they'll come in during the day. And what you can do is manage your trade optics queue. You see what's happening right now, I'm looking at all of these strategies. Ooh, I got one. Check this out. Okay, so here's GS, right? RSI mean reversion. So guys, I got really lucky today. This is awesome. I'm looking at these MACD values, right? And what had happened was it says, okay, Goldman Sachs, right now, the MACD value is bearish, right? It's negative, right? So I want to be looking to go short, most likely, in this situation. And on this particular day on Goldman Sachs, I'd say that's a great idea. The trend might be a little extended, so you'd want to be very careful. But look at the signals that it would have gotten using my basic, almost a little bit naive strategy. Would have gotten a signal to go short here, right? Which, again, it's not the perfect signal, but it's the general indication. And it's saying it's a good idea to look for shorting opportunities here. Right now it's saying the same thing based on a little movement, right? But you have to make the decision. You have to say, okay, it brought this idea to me. Do I agree with the idea, and do I consider this a good move or a bad move? And the scanning system presents you with a lot of ideas, so you can kind of do a survival of the fittest. This move in particular, it's not bad, but I'm a little skeptical on it just simply because it's been extended in the downside. What I would do personally is I would look very strongly at the general market direction, and I would, make a decision, based on, say the SPX. I also personally, I love looking at 1-minute charts, smallest resolution as possible, because what that does for you is it gives you the most amount of information. And you can always kind of zoom out and kind of look at what's going on. And so what's happening on the S&P is you see it gapped down. There's a bit of support, and then it's kind of going choppy, but we may be at another reversal. So it's a little iffy, right? But if I go back to that Goldman Sachs, if I decided that this was a good time to go short on this RSI mean reversion, all I've got to do is go into my order management that's kind of preloaded, and I can toggle my parameters however I want, and I can just kind of send that order, and now I'm short Goldman Sachs right now at 96.86. So everything's kind of tied together. But consider the merits of this strategy, right? And actually, I do peek at this chat from time to time, and I try to to look at things just to make sure that I'm kind of going in the right direction. This is actually a really good question. Would you set the short trade at RSI for the mean to cross back below the RSI instead of back above? And to be honest, that's just flavor. That's exactly only how you want to do with it. What I'm doing is, my train of thought, because I'm building a trade optics scan, this is not like a robotic trade right now. I want to know when the signal happens as early as possible. And in order for the RSI to kind of cross back below, right, if you're in a downtrend, there's a pretty good chance that RSI is negative to begin with. So in order for it to cross back below, it's going to have to cross back above first before it crosses back below. I mean, that's kind of what happens here. And so I want to see the signal as early as possible. So I would see the signal here on this bar right here when it crosses above. If you say wait for the confirmation for it to cross back below, you would see the signal here on this bar. And it really doesn't matter. See, this would be a fantastic signal if you did this robotically or even in trade optics, because you just start in the money already because you waited for the confirmation. It's really just what you want to do with it. And trade optics is beautiful because it really just brings the idea to you. It doesn't force you into making the trade. You can kind of be selective about it. So that's why in this version I chose to see the signal a little earlier without the confirmation, and I'm doing the confirmation manually. This becomes like a semi-automated trading system. In this example, I get the signal here. It crosses above, right, and it kind of gives me the signal on the next bar, and then it just would have been one bar after that, because it crosses back down below almost immediately after. So again, the idea behind this strategy, right, is it's finding some relationships in the direction of price movement which are not as immediately obvious. I mean, you can look at a chart and you can kind of look for the pullbacks and things like that, but it's very difficult to build a trading system that just finds pullbacks, right? So for example, I could do something that looks for moving average crossovers, but that's very kind of rudimentary. And by using the idea of overbought and oversold to find my trigger, that's even a faster trigger than an EMA actually, because a lot of people refer to RSI as a leading indicator. Don't cross your terms. Leading indicator doesn't mean predicting, right? Leading does never mean predicting. It just means that it presents you the setup, which may or may not happen. So RSI is kind of like this leading indicator. It's kind of preemptory, but not predictory. And the MACD is more of, I mean, obviously I was saying momentum, right? It's showing you how the trend is behaving. So this system, even though it's very rudimentary and basic, it doesn't, it's not as blunt as a simple moving average crossover system or a simple RSI crossing above or below 70. It's smarter than that because you're pulling out more information in the relationships, and that information has value to your trading, right? So, I've been watching this Goldman Sachs signal, and it's not bad. I mean, it crossed up, right? And if you had taken this as a short signal, you'd be in the money right now, just a little bit, but maybe about 10 to 20 cents in the money, and it's not bad. You're making better informed and more educated decisions by being smarter than the average bear about it. And hopefully that's what I was able to kind of convey to you guys today. You can always get confirmation. That's another good point, by putting moving averages on here as well. That's a really good way to kind of add confirmation into a system by just applying more moving averages and comparing your original signal versus the moving average signal. So I'm going to leave you with this thought. This was very basic, and it was intended to be basic, but the concept is very sophisticated. In my opinion, personally, those are the best kinds of trading automation. When you start with a sophisticated idea and you express that idea in as simple as terms as possible. Right now, you already have all of these instruments available, all these technicals. You have the RSIs and the MACDs. You've got ATRs. You've got CCI for Commodity Channel Index. All these things are out there. Stochastics, all kinds of moving averages, etc. Linear regression. These express very simple ways of measuring, quantifying certain concepts. And if you take a sophisticated idea, my advice is to try to find a way to express that sophisticated idea in simple mechanisms. Because the automated systems that you develop are only as good as the fundamental idea. There's no holy grail formula that tells you to buy here and sell here. But if you have a system with enough filters in it and the correct triggers to find opportunity and manage that system, you can profit to a great degree. And a lot of people make their living, doing this stuff. A lot of you guys out there are, day traders, making your own living doing this stuff. So you guys know what I'm talking about. But that's how I see this system. And so this idea was how to combine the concept of momentum with the overbought and oversold trigger of the RSI, hopefully in a way that you really didn't think about it before, by comparing it against its average. And what I wanted to leave you with is you can take that idea and apply it to any indicator. You see this white dotted line and the red smooth line? All I did was just copy that idea from MACD and put it to the RSI. I take this white dotted line and I compare it against its red moving average. You can do that for RSI, for ATR, for volume, anything, linear regressions, anything. And you can always, take differences. We do the difference between a MACD against itself. You could take the difference of the MACD and the RSI. Whatever your idea is, just try to keep it simple and try to focus on the relationships, and you can build some really powerful systems. So that said, I'm going to wrap up today's chat by saying thank you guys for joining me today. It's always a pleasure. Every week, Wednesday, 12 Central, 11 o'clock Eastern. These chats are archived on www.prodigiorts.net. Prodigio activation is support at thinkorswim.com, and specific questions about Prodigio or trading to Prodigio at thinkorswim.com. Follow us on the web, twitter.com/wizardlab, and join us here in the chat room. So thanks, guys. It's been a pleasure. Hope you gained something from my ruminations, and I hope this helps. And as always, great trading, guys. Take care.